Okay, so let's go ahead and continue. The question that was being asked earlier when we began our discussion about some slight differences, a couple $1 million, slight differences in some of the valuations, had to do with how some of the numbers were being put together. Remember that in the question, was it 10?
Yeah.
Okay, that you move from the free cash flow formula to the KVD formula. And you're given the free cash flows on the very first page of the problem set. And in the question for number 10, you're given the no-plat for year 13. And I believe you're told that G for no-plat and G for free cash flow are synonymous, same number. Okay. You need to use no-plat for year 1 of the continuation, which when we have a 13-year explicit period, which is unrealistically long, right? But when you're using a 13-year explicit period, year 1 in the continuation is year 14, right? So now you need to apply the long-run growth rate to that no-plat that you're given. So it's 26,500,000. You're going to multiply it by 1 plus, I think, 0.04.
Yes.
So it gives you another number. That's the no-plat you will use in the continuation term. Okay? So it's the year 14 no-plat, which you have to synthesize. Okay? And once we did that, the numbers lined up. Done. So that kind of helps some of you that were curious about that. If you have any other questions, maybe afterwards I can talk about it a few more minutes, or you can talk to these guys and work it out with. Okay. So with that, I want to walk through a little bit of the problem set that you're going to do, and then I want to start to talk a little bit more about forecasting. Pass those along, please. Pass those along. And start to read this case while I do some work on the board.
Yeah.
Thank you. Okay, so for this, once again, I've given you a series of free cash flows, and I've given you the series of no plats that goes along with them. Okay, because you're going to use both the free cash flow model and the KVD model. And I've obviously given you some information about the bond portfolio, so you know what's in your future. You're going to be calculating the market value of debt. I've given you some information about the equity portfolio, which RM, RF, beta, sounds strangely like you're going to be responsible to calculate RE using the CAP-M equation, right? Those are the inputs. And I give you investor required return. So if you're calculating RE using CAP-M equation, sounds like you're going to create a WACC, right? And that's going to get, you're going to come up with some number for WACC. But I also tell you an investor's required return, which is going to be a different number. Let's look at this for a minute. I'm going to generalize this for a second, but I think it'll make sense to you. If I look at this and say the value is the sum of some free cash flows at times I divided by 1 plus WACC, or I'll generalize that and say R. 1 plus R to the T. If R equals WACC, and it equals, let's say, 10%, then we can figure out what this number is for each of these terms, right? Not an infinite number of them, but we know, we can figure it out. And let's assume for a minute that we've got the R of 10%, we come up with a number. If we say R is equal to a required return from an investment, and it's equal to 18%, if the free cash flow hasn't changed, but the R changes from 10 to 18, when the R was 10, was this term larger or smaller than when the R is changed to 18? Larger. When the denominator is larger and the numerator hasn't changed, the value of the term is larger. Okay? So when we move to, when the denominator is smaller and the value in the numerator hasn't changed, the value of the term is larger. When we move and say that this is 18%, now the denominator is bigger, the numerator hasn't changed, the value of the term becomes smaller, right? Again, since I misspoke the first time, if we have a 10% R here, and I then say that this is equal to X, if the R becomes 18%, then does this become equal to X, or is it equal to something larger or smaller than X? Smaller. Less than X. Now think about the concepts of bid and asked. So when I am buying an asset, I bid for it. When I'm selling an asset, I ask for a price, right? If I'm selling it, I want to get the very best price I can find. Highest price I can get. When I'm buying it, I want to pay the very least amount I can. And there's a negotiation that might happen in the middle there, we might agree. Can you see then that if X is based on the seller's discount rate, that sets up the concept of ask. And if less than X is based on the investor's discount rate requirement, it sets up the concept of bid such that bid is less than asked, as it always is in our markets. So when you think about the difference between bid and asked, even in something as simple as a listed stock on one of the various stock exchanges, where the difference between bid and ask is not a big number, right, on a per share basis. But when you take that 3 cent, 2 cent, 25 cent difference per share, multiply it by 200 million shares outstanding, does that set up a big difference in the overall market cap of the common? Bid and ask is the difference between bid and ask is a function of the investor's required return versus the firm's cost of capital. Does that make sense? I'll bet you that not 20% of the professional investors out there understand that. And because of that, they're not able to calculate what their bid or asked should be. And so they're guessing, and we create inefficiencies in the market. Okay? So that's not nothing. Okay, let's come back to somewhere we're headed with forecasting. So I want to breach into forecasting for a few minutes. Oh, let's finish up on this problem set, and then we'll go into forecasting. Excuse me. So the reason I give you, don't be laughing at me, Colin. I'm trying my best tonight, brother. So you've gotten both the required return, and you're going to calculate WACC, and now you can begin to see why that might, or how that might come into play later on in the problem set. So I ask you to calculate WACC. Big surprise in number 1. I go on and then ask you to do a valuation using a free cash flow model in number 2 from the perspective of the investor, of the firm, right? The very last part there, model from the perspective of the firm. I also tell you that the free cash flow model is simply an augmented form of the dividend yield model. You might see those words elsewhere in one of my problem sets. It's an augmented form of the dividend yield model. What was the dividend yield model? P0 equals D1 divided by R minus G. That's a continuation term because it takes into account all perpetuity, right? Well, what's the augmented form? Value at time 0, not P0, but value at time 0. Still, it's a price, right? equals FCF1, a cash flow, just like dividend is a cash flow, divided by WACC minus G. Same thing. It's the same model, just substituting different variables that are alike in their construction, or like in their types, if not their exact construction. So it's a valid model. Okay? So you're then asked to come up with the exact same, or with a calculation using the KVD model. And then in number 4, I ask you to try to explain to me why this is, that they are different. You're going to find they're not hugely different, as it turns out. They're different by some thousands of dollars. So you're asked to tell me why. When you do this, think back to all of the conversations we've now had, which has probably been 4 or maybe 5, as to the functional difference between free cash flow being equal to no plat times 1 minus G divided by ROIC versus free cash flow being equal to no plat plus depreciation minus change in net working capital minus net capital spending. G is the difference, right? So you can then think about discussing that for me. And I think for those of you that this is still a little bit fuzzy, having to discuss it here will clarify it a little bit. That's the intent of this. And then finally, number 5, you've been asked to help the firm stakeholders, prepare for something, and so you're going to rerun both of these, but I think you're going to rerun them from the standpoint of the investor rather than the firm. Which simply means you're going to use the required return instead of WACC. They're both discount rates. If you've set up a multi-columnar model like I've shown you to do now, and like you have some template examples for, then all you have to do is plug and play. Okay, this should be pretty rapid for you. Fair enough, Shelby? You're all over it?
Hope so.
Can I sit there and you stand here and finish this out?
Absolutely not.
Sissy. Okay.
Yes, say yes and be dismissed.
Yeah, right.
Yeah, you're right.
Well, as it turns out, it's only 8 o'clock, and we're not all that far from doing it. So let's talk about forecasting. We began by talking about some concepts for growth tonight, right? Or fairly early in our discussion. Talking about some concepts for growth. And this is all about thinking about how revenue is created. Well, in here, maybe we've got some history that we probably can't diverge all that much from our company's history. If my company's history is an average of 7% growth, for me to think I'm going to get 29% this year, doesn't even make good plausible sense. Unless that average has gone from 2% to 3, 4, 5, and then started to march up pretty quickly to get to the average, right? But if the average is, we've not deviated much from the average over the last 10 years, to think that we're going to triple it now is probably not very realistic. So we've got some path dependency. And that might be a function of how we've been reinvesting our capital and our retained earnings, right? That's going to be a driver of our growth, because when we reinvest retained earnings, we are putting it back into the company so that we can grow or solve a problem, right? So our history does tell us something. The market, both the macroeconomic market of the nation state and global economy that we're in, and the microeconomic market of our firm, and the market in which it finds itself amongst its peers, is relevant to us. If we're thinking that we're in a marketplace where the average firm in the industry is going to do 15%, and we can find reports all day long about the average, the expected growth rate for a particular market, right, in a given time, then we have every reason to believe that unless our firm is an also-ran, that we also should be able to find that same kind of growth rate over the next period. Maybe we then also have to think about our position in that market. Are we a market leader? Do we have greater brand loyalty? Are we more innovative? Are we a small company that follows? Are we a company that just is struggling to keep up? Are we a company that is got 10 million in revenues against a market of 3 other companies, each of whom have billions in revenues? Or are we pretty much an average equal player in the rest? Or are we better than? So there might be a position which could be a follower disadvantage, it could be a leader premium. If we're a leader, let's say the market, the micro market was going to give us 10%, and we're a leader, could we realistically get another 2% on top of that? Okay. If we've committed to organic or endogenous growth by our R&D spending and our innovation over the last 3 or 4 years, and proportionately, we believe that's going to goose our sales by another 10%. Proportionately, if we think they're going to be 12% given our market and our position in it, but we have this thing happening inside the company with our own innovation that we think will give us another proportionate 10%, then 12% adding to it a proportionate 10% is what?
11.
Well, we're already at 12.
So 13.
Yeah, so 10% of 12 is 1.2, so we'd be at 13.2. Pay attention to proportionate versus nominal. Nominal is, if we said it's going to be another nominal 10%, then 12 would become 22. Okay? So those are areas where we can think about how we look at our sales growth. Once we've identified our sales growth, we can begin to look at forecast ratios. So the first forecast ratio that we're looking at is sales growth. So forecast ratio on sales or revenue. And let's say that happens to be 10%. We've used our best guessing. Maybe we've been a little optimistic, or we've taken some optimistic inputs. And we then have to think, okay, is it realistic? No, I better adjust that. I actually came up with 15%, but every one of my 6 inputs was a little bit optimistic, so I'm going to dial it back just a little bit. Are people ever bothered by having more? No. Are they bothered by having less?
Yeah.
Investors for sure, right? So if you've got a hedge yourself off a little bit. No one's ever going to fire you because you did better, right? And unless you think getting promoted is having been fired from your old lousy job. Okay? So the first forecast ratio you're going to think about is your sales forecast. Think about this. If I know that I have a revenue in my base year of $1 million, and I have cost of goods sold, which is just one of many different expense categories in the operating expense area, right? If my cost of goods sold was 35 or 350,000, I can have a forecast ratio for my COGS, which is equal to 350,000 divided by my million, or 35%. So the forecast ratio for expenses is going to be the expense experienced in the base year, or maybe an average number of years prior to the base year, divided by the revenue in the base year, or maybe an average revenue in a few years prior if you're trying to average out some anomalies. Whatever the expense is, divided by revenue, gives you a ratio, and if your COGS is 35% of sales in your base year, you have every reason to believe, absent some improving economies of scale, that your COGS should be 35% of your revenue in year 1, and year 2, and year 3. You do, right? If you've seen a pattern, unless you change something, the pattern is going to hold. So as I've given you forecast ratio for COGS, let me generalize it and say the forecast ratio for expenses is equal to the expense in a particular year divided by the revenue for the particular year. Okay? So now, I kind of like that. Working okay for me. Remember, my revenue in year 0 was $1 million. what's going to be my revenue in year one?
And to times that million into 1 plus the growth.
Yeah, so 1 million times 1 plus 0.10, or 1,100,000. What is my COGS expected to be in year one? Yeah, so take 35%, somebody with a calculator, please do this quickly. Take 35% of 1,100,000. There's 17 people with calculators in front of you. One of you. Oh, you're killing me. This is called a collective action problem. When everybody thinks something. Okay, say again. Thank you. You're our salvation. The rest of us are slaves. Okay? Well, this forecast ratio for expenses must be applied conceptually to every expense category. I gave COGS as an example. We might have sales and administrative salaries in this base year of 200,000. In which case, I would have a forecast ratio of sales and administrative salaries equal to 200,000 divided by the million in revenue, or 20%. I might have a forecast ratio for depreciation that is 35,000 divided by the million, which gives me 3.5%. So as long as I create a forecast ratio for every one of my expense categories, I can now forecast my expenses for each and every year in front of me by first having forecast my revenue for that year, and then I can forecast the expenses for that year, in which case I've effectively forecast EBIT for that year, haven't I? If I know EBIT, if I know my tax rate on EBIT, I now know no plat. I'm on my way to free cash flow. That make sense? Well, I'm only on my way to free cash flow. I'm not quite at free cash flow yet, am I? Depreciation, yeah, I'm there. Because I've got no plat, I got depreciation. But change in net working capital and net capital spending might be a bit of a bugger for me. So I'm going to show you in a minute on the template how we see those. Okay? We also have a forecast ratio for interest expense, and it's different than the forecast ratio for the other expenses. It's a different structure. I'll go to the other part of the board since this one's a little low. Forecast ratio for interest expense is equal to the interest expense in time 1 divided by the debt in time 0. Does that look familiar to you? Let me suggest that it should. It is one of the acceptable but not optimal ways of finding RD in the wacky equation. You remember it now, right? That 1 year temporal offset? Because we tend to pay interest on debt we've had for a period of time. We don't pay interest on the debt we have right now the day we're paying interest, right? It's over a period of time the interest is accumulated and calculated. But that's the forecast ratio for interest. So that's good. I can forecast my no plat. I can forecast my depreciation. I can forecast EBIT. I can forecast interest expense. I can forecast everything all the way to taxable income on the income statement, can't I? And I apply that taxable income to a tax calculator. I have now forecast net income, haven't I? I've forecasted with net income. I forecasted ROE, ROA, IGR, SGR, DuPont, non-DuPont. I am off to the alphabet, right? All I have to think about is how did I get there? I forecasted. But here's a problem. Manny,
Yes.
your company was a $10 million gross revenue company last year. You have every reason to believe, and we think you're right, that your company will be a $15 million gross revenue company in 2 years. Not because of inflation, but because of the scale of your operation. You simply are selling more units, maybe at a slightly higher price, but you're selling many more units. Is it reasonable to believe that your expenses should grow at a slower rate than your revenues. Here's another way of me asking you. When you bought 1 million units of something, did you get a better price than when you bought 10 units of the same thing?
Probably.
A much better price, right? And what do we call that? We call it economy of scale. So as I go from 10 million in revenue to 15 million in revenue, and it's not simply a price change per item, it's more items, should my expense per unit go down?
Yes.
Yes. If my expense per unit goes down, doesn't my forecast ratio on that particular expense category have to change? It does, doesn't it?
It's not linear.
So I have to think about how that happens. I'm going to come back to that in a minute. Because this doesn't give me a good reflection of a changing economy of scale, or changing scale economy, or changing returns to scale. This gives me a constant returns to scale world, doesn't it? Well, why do we scale businesses? We scale them to make more money, but we scale them to make proportionately more money still than the scale change, because we think we can pick up better economies of scale. Part of the reason we merge other operations into our own. I'm a CEO, Kaibo's a CEO. We merged our companies. Kaibo, do we need 2 CEOs now that we have one company? No, there's only one chief, buddy. It's either you or it's me. We may have to settle this out on the playing field or the back room, or just go away, right? So there's only room for one of the two of us, because both Kaibo and I have fairly big personalities, right?
Yep.
Okay. Right. Only room for one of us. This, by the way, was one of the problems with the Franklin-Covey merger, because Stephen Covey and, oh, his name's going to come to me in a minute, I can't remember.
That's gone.
Pardon?
The other guy that.
The other guy, well, Hiram Smith, who was then the president of the Franklin organization, decided to become co-CEOs. Because they were all about harmony and working together in efficient workspace. Remember, this was back in the days when we thought you could have self-directed work teams as well. Not so much with that, okay? So we don't need 2 CEOs. So we get rid of one of those expenses. We immediately created an economy of scale in our sales and administrative costs, right? So these are some of the reasons you do this. Or maybe what we did was Kaibo's company has their own warehouse somewhere else, and we decided we don't need both those warehouses or both those production facilities. My production facilities only run an 8-hour a day. Let's go ahead and have it run 16 hours a day. It's the same footprint. I don't have to buy real estate twice. I have created an economy of scale, right? So this is how you think about a forecast ratio. When we think about scale economies, or sometimes best owner premiums, or leadership premiums that we might get because of changing some of these things, the first thing we have to do is we have to calculate the forecast ratio. From the forecast ratio, we multiply it by the new expected revenue to get to our expected expense. And if we believe that we have a 2% scale economy benefit, or 2% best owner premium, and I'll describe what best owner premium means in just a minute, I now take my 2% benefit off of this $385,000. So I can then multiply it by 0.98, right? Or 1 minus my benefit. So 385, I'm going to wait for you people. I've learned that lesson tonight. Ooh, that's not the answer.
3773.
Gosh, 3773, he beat me to my own punchline. So that's my projected expense for that category. I first identified the forecast ratio. I then applied the forecast ratio to the revenue to get the expected expense. And I then took the proportionate premium. A premium in expenses is a reduction of expenses, right? A premium in sales is an increase in sales. So I took a best owner premium of 2%. What's a best owner premium? Well, you know, I'm not a bad business operator. I've made a couple of dollars. But Kunji is a much better one. And if this company now goes into his company's hands, he has shown a better track record. He's a better owner, maybe because it expanded into a much larger scale, maybe because he has better supplier contracts, maybe he manufactures in Payson where it's hard to get jobs, wages are less, and I manufacture in New York City. Or we're still San Francisco, highest labor market in the country, right? Move it to his, we get a best owner premium by a reduction in the price of labor. It's a best owner premium. And we can think about that as a proportion. But we identify what we think the dollar value should be based upon the ratio, and then we apply the other, or the premium. Why don't we just take the 2% off of the 35%? Such that we've got 11, or 1,100,000 times 0.35 minus 0.02, or 0.33. What's 1,100,000 times 0.33?
363.
Pardon me?
363.
363. Which is not the same as 377. So when you're forecasting and you believe you have a scale economy benefit or a best owner premium benefit of some kind, you have to order properly how you've calculated it. If you don't, then you end up with the wrong answer and you can go off the rails pretty quickly. Because when we think about a premium, it's on the entirety of the expense, so it's proportionate, it's not nominal. If it was nominal, we could do this, but it's not. They're proportionate. Okay? Does that make sense? Okay, let me bring up a spreadsheet template that I can show you this writ large. Everything but what I want. Good. Okay, I don't want the fact that there's 1,000 numbers on here to bug you. Okay? Expand this so you can actually see some. You guys read these? Okay. Chris, can you read this one back there?
Yeah.
I saw you needed to read these really up close there for a second, so I didn't check. Okay, so what I've done is I've gone ahead and I've replicated year 0 from my financial statement. And my financial statement is exactly what you think it is. You guys have seen this format now numerous times. And you can put any company's financial statement into that format, right? So I've replicated it. Why does it keep asking? And I've got, from year 0, pulling straight out financial statement, my revenue, my debt, my labor expenses, all these things, depreciation, leading up to EBIT. I've got an interest expense, again, right off the income statement and balance sheet. invested capital, and so on, all the way to free cash flow. You guys know how to do that.
So
Please.
what are the numbers up the side where it says interest expense and FA5?
They're footnotes to some things down here.
Okay.
And I'll look at those in a second. I'm actually about to talk you through them.
Okay.
Okay. With those values, I now can create my forecast ratios. I somehow, in another sheet, decided that my forecast ratio on revenue was going to be 19.5%. So I was expecting during my explicit period, I'm growing my revenues at 19.5%. I calculated that on another sheet. And if I look at my revenue in 2018, which is year one, it is 19.5% bigger than it was in year zero. Okay, simple. Having calculated the forecast ratios for my base year, I know that labor is 21.93% of revenue, because that's how the forecast ratio is calculated. Which means I should be able to take this 21.93%, apply it to my revenue for a year in my forecast, and get my expected labor cost in that year. Do you see that? I take the revenue that I forecast for the year, I multiply it by the expense ratio, or the expense forecast for that year, or based on my base year, and it gives me the expense for that year. Exactly as I showed you on the simplified version on the whiteboard. And I've done that for each and every year in my forecasted expenses.
Can you highlight the cell?
Yes, absolutely. You may see something a little bit more complex that I'll have to talk you through.
Okay.
You do. But I can change that. A second. And my number didn't change. Okay? You'll see why in a moment. So now what it looks like is the ratio times the revenue equals the new expense. Simple as that, just like I did on the board. Okay? And I'll come back in a minute to why that cell looked much more complex. I don't want to be there quite yet. If I've forecasted one of the expenses, I have forecast EBIT. Now you might say, well, if these expenses are all changing at these forecast ratios, which is changing, and the ratios are all built upon a revenue that's changing at a constant rate, 19.5%, then my EBIT also changed at 19.5%. These all changed at that 19.5% rate, right? But that's a mathematical reality, and that's not the case if I introduce any economies of scale or best owner premiums in my bunch of forecasts. So I'm going to ask you to not think that way. Instead of saying, well, if sales are growing at 19.5%, then my labor grew at 19.5%, which if you look at it mathematically, it did. Don't do it that way because you're going to miss a very rich next step when we make adjustments. I'll show you the adjustments in a moment. All right? Well, I forecast my EBIT, which means I forecast my no plat, but I need to forecast free cash flow. And to forecast free cash flow, I need to think about net capital spending, and I need to think about change in net working capital, don't I? So that's a bit of an issue for me. Can I simply believe that my net working capital changed at the same rate as my sales?
Yeah.
I can. I'm not sure that that's always credible. Can I assume that my fixed assets changed at the same rate as sales? I can. If I'm making those kinds of assumptions, should I state my assumptions?
No.
By footnotes, like 5 and 6, and such that you asked about. Okay. But let's think about that for a minute. Can I credibly assert that my fixed assets have changed at the same rate as my sales? Well, if I make money in my company based upon the use of my fixed assets, my printing press, and if my scale economy or my efficiency of the way I use my assets doesn't change, then I am arguing that my fixed assets and or my net working capital, which is assets, right, and liabilities, changed at the same rate. In fact, if I want some backing for that, I can look at the firms in the S&P 100 and the Dow 30 Industrials over the last 17, 18 years, and I find an amazing correlation in the percentage change in their revenue and the percentage change in their asset base. Unless I'm looking at banks, insurance companies, and financial holding companies, which operate on equity, not assets. And if you look at their equity change, you can see what's happening to the revenue change, you can see what's happening to the expense change. Okay? So we've got some good backing for this without an economy of scale. Well, why is it without an economy of scale? Because those companies in the S&P 100 and the Dow 30, are they big companies?
Yeah.
They're the biggest companies. Are they probably at max scale benefit already?
Oh.
Yeah. Is there a big price difference when you buy 1,100,050 items versus when you buy 1,100,000 items? No, right? So yeah, they can pick up a little bit of additional scale, but they're probably already at max scale benefit because they've already probably squeezed the suppliers so tightly that they've got the lowest possible price from the supplier already. Buying a few units more is going to drive the price per down any further. So they're already at max economy of scale. Well, largely when we're thinking about valuing assets, we're thinking about private assets, which probably aren't already at max scale economy, are they? So if they get bigger, we might be able to pick up some benefit. So let's think about how we forecast them. I'm going to go back to the cell that I just took apart. Okay. So we Control Z this enough till it goes. There it is. Okay. Yeah. So in this case, what I've done is I have gone ahead and I've taken my forecast ratio and my revenue. I've interacted them, just as I showed you on the board. I've multiplied that by 1 minus my adjustment. I haven't put a number in the adjustment, but I've got a cell for it because it's a model, right? 1 minus the adjustment. Remember, we took the revenue that we expected times the ratio, came up with a number, and then multiplied that by 1 minus the benefit, 2% that I thought we were going to get. Now here I have this to an exponential power. Let me explain that in a moment, okay? Forget that for a second. Just see how this works out. If I go ahead in this model and say that I have an adjustment, maybe it's a scale adjustment, maybe it's a best owner adjustment, of 0.02, it changed that cell, and as it turns out, because I used the same kind of formula all the way, it changed it all the way down, right? It's a model. I didn't have to go into every cell. I invested the time of architecture and construction so that I could use it over and over again with simple modification. But let's think about this. If getting a little bit bigger this next year brought me a 2% scale economy, is it likely that getting that much bigger still the following year will give me, again, exactly the same 2% scale economy? Or as I get proportionately larger, should my scale benefit get proportionately larger? As I went from 1 million units, and I paid $1 a unit, to 1,100,000 units, and I paid 98 cents a unit. If I go from 1,100,000 to 1,200,000, will I get another 2 cents off, or am I perhaps getting to a point where I maybe get more than another 2 cents off? So you have to make an assumption about this. And in this spreadsheet, what you saw modeled is I have taken this adjustment to an exponent, which means I got 2% and another proportional 2% on that. So it's a growing scale economy as my scale is disproportionately increasing. Does that make sense? This is hard. This is a hard one. Okay? We'll talk it through for a few minutes. I don't believe you're using it in any of your work this week. I want you to put this one on for size a couple of times, and you've got these same spreadsheets in my Excel templates, and you can see how it's applied. So don't just sit and look and take notes or watch the video, go into the spreadsheets. How did he do that? What's that for? Oh, that relates back to this comment. Here's what we're looking at. Here's how to construct this. And in a couple of weeks, you'll start really using that. Okay? What do we think, Sophia? You're all over it, right? Or is it a little over us right at the moment? Be honest. Mazen? We're okay? All right. Straightforward? All right. Well, as it turns out, I've built this entire spreadsheet on a couple of very simple assumptions. One, and I'm going to take this back to a 0 here for a second. Excuse me. One is that absent any adjustments down here in my expense categories to represent best owner premiums, scale economy benefits, etc., absent any of those, all I need to do is forecast revenue for future years and forecast what a particular expense is as a percent of the revenue for the base year, come up with a forecast ratio, apply that ratio to a future year revenue, and it gives me a future year expense. I've also said that I believe that my assets, net working capital, fixed assets, probably grow at the same rate as my revenues. And I've got good reason for that. If the company makes money off of its assets, and if we have no scale economy changes, then the fixed assets would grow at the same rate as the revenue, in which case I've been able to have my net working capital and fixed asset values, and if I have no plat plus depreciation minus change in net working capital, that's why I have both years here, so I can see the change, minus net capital spending, which is fixed asset from time 1 minus fixed asset from time 0 plus depreciation, I now own free cash flow, don't I? And I have a free cash flow forecast. Can you see it? Sort of? You'll see it a lot better when you play with it, I promise. You'll see it a lot better when you talk to each other about it. Okay. What kind of questions would you have about this? These templates are online for you. Well, I know one of a few things is true when we have this level of silence. It's either approaching 9 o'clock more rapidly than I thought. By the way, I don't know about y'all, but I'm a little bit tired tonight. Yeah, to be.
Would you ever take your model, because I mean, you're just basing this off of 1 year, I mean, if you did like 5 years as like you're supposed to kind of develop what your...
Here's another way of thinking about it. Would I ever take, and instead of applying this growth rate, where it is, right here, 19.5%, to each and every year, might I adjust the growth rate of revenue? Sure I would.
Okay.
What we've done is we've suggested, and I think is where you're going, if not, please correct me. What we've done is we've suggested that we're going to see an average growth of 19.5% every year. But I might have come up with a forecast that says it'll be 19.5% next year, 18% the year after, 20% the year after, and such. And all I have to do to adjust the model for that is put a percentage growth rate somewhere next to the year, and instead of have every year grow at this, have the years grow at what I think those are going to be.
Okay.
So I can now focus them on different annual growths, changing growths, which I think is probably more realistic, right? And if I can simply believe my scale economies don't change, I can still operate this revenue, which might have been based upon this growth rate, and this expense ratio to get that expense. Or if I believe that I actually have changing economies of scale, I can put an adjustment in here that let me not only change my revenue growth year over year, let me change how the expense growth worked as well. Some of this is going to get relatively complex in our model. You will use some of this, not the most sophisticated of it, not the hardest of it, but some of it in some of the work you'll do. But I want you to see examples of more sophisticated elements, because you're going to be in a situation one year where your boss, Kuhn, comes in and says, hey, Sophia, I want you to model our company's revenue and expenses for the next 5 years. The analysts are coming and they expect it. And I want you to believe that we're going to have these kinds of revenue increases Our marketing group promises them. Our CFO's group says that as we get bigger, we pay less per unit, and so we have a scaling economy. I want you to be able to model all that, and I want you to tell these guys what free cash flow is going to be. And if you don't think through ways of modeling, then you're going to sit there like a deer in the headlights, right? If you've seen them, you might be able to go back to some things and think, gosh, I know I saw that, saw something like it. Maybe it's not a financial statement. Maybe it's a production schedule, right? Maybe it's 1,000 things. Financial modeling is huge. What other questions? Okay, I'm going to let that be it for you. I think you've had enough. We've gone through a lot, okay?